Inflation is taxation without legislation. This quote by Milton Friedman, a Nobel Prize winning economist, describes how inflation can erode wealth. Hi guys, it's me Vedant, and in this video we're going to discuss about inflation and in specific how we can invest better during times of high inflation. Most of us are aware of what inflation is and how it works, but let's just briefly recall it anyways. Well, due to inflation, the cost of various goods and services tend to rise with time and the currency gets devalued. Basically, what it means is that for the same 10 or 20 rupees, we're going to get fewer and fewer pani puris in the future. Let us now focus on what inflation means for an investor and how it affects an investor. Let's say our returns from our portfolio this year or our investments has been 13%, but the inflation itself has been suppose 5%. It means that our real return for this year is actually not 13% but only 8%. We call this the real return because even though we have gotten 13%, the money itself that we have now got has gotten devalued by 5%, which means we cannot actually exchange it for the same amount of goods and services. And this is why we call it real return. The portfolio returns minus inflation. So if you haven't already begun investing, know that your money that is left idle in your bank account or cash gets eaten away year after year progressively by inflation. So you can consider you opening your Demat account using the link below with Grow. It is the broker I use and have also reviewed it on the channel. We can now appreciate what inflation does and means to an investor's returns. It has a very direct effect. Now let's look at what inflation means for a business, and by understanding what problems a business has due to inflation, we can then deduce what type of companies we need to invest in to fight inflation effectively. What companies and businesses struggle most with is called cost push inflation. This is when the cost of various raw materials and other input costs such as petrol, oil, or metals, all these tend to rise. And we are actually observing this right now as well. When the costs of a company tend to rise, they have now got to make a decision whether to absorb those costs and decrease their profit margins or pass on these additional costs to the consumer itself. If the company plans on absorbing the costs and not increasing their sale price, this means that the company must now have to sell many more goods and services to keep their profits constant as well. If a company wants to increase the volume of goods and services sold, this means that they must be easily scalable and they must be capable of expanding their business at a pretty low cost because they wouldn't be able to do that otherwise. The problem with raising the sale price and passing on these additional costs to the customer is that in a competitive environment, the customer is highly likely to use a different supplier, and this causes the business to lose some of its customers. We have now struck on two key parameters that a company must have, or qualities that a company must have in order to beat inflation and not get crushed by it. These are, one is called the pricing power, which is the ability to pass on the cost to the customer, and the other is low capital requirements and easy scalability of the business. These two qualities were stated and described by Warren Buffett in one of his annual letters to his shareholders. Let us now dig into these two qualities that we have figured out and understand them better. Let us look at pricing power first. As we discussed, it is the ability for a company to increase its selling price without having to worry about losing customers. The best example for this is Apple, the company that makes iPhones. Well, a person who has decided to buy an iPhone is highly likely not going to change his mind if the new iPhone is 70,000 or 80,000. A person who has made up his mind to buy an iPhone is probably not going to change his decision over 10,000 rupees also. Another example of this would be Royal Enfield. A person who has decided to buy the bike Royal Enfield is highly likely not going to change his mind if he happens to have to pay 10 or 20,000 more. But that is true, however, when we come to the lower range economy bikes and scooties. A person can actually change his mind if the price difference between two scooties is 20,000 rupees. Some good examples to understand this concept in India are Ola and Oyo. For example, let us take Ola. They actually do not have full-time employees. They pay their drivers based on how much they work. And they also often do not have to own the car, which means that if they want to two times their business, if they want to increase their business two times, they can actually just go to new cities, find drivers, network with them, get them onto their platform, and use the customers and other people that are already there in the city. They actually do not have to buy two times the number of cars or hire two times the number of full-time employees, which means they do not actually have high capital requirements. The same goes for Oyo. They actually do not need to construct two times the number of hotels in order to two times their business or increase their revenue two times. They just need to go to new locations, network with the existing hotels, and get them onto their platform. This quality is common among companies that use tech in order to scale. They require less capital and they can scale their business quickly and rather easily. So that's it for this video, guys. Make sure to smash the like button and subscribe if you haven't already.